Something is quietly building in Washington right now. And if you've been watching silver, really watching it, you already feel it. That low hum of pressure beneath the surface, that sense that the market is holding its breath, waiting for something it hasn't fully priced in yet. Today is May 11th, and in the next few days, the United States Senate is scheduled to vote on a debt ceiling and fiscal package that could trigger one of the most violent silver corrections we've seen in years. Not because the vote itself directly touches silver, but because of what it signals, because of what always happens when Washington decides to play fiscal brinkmanship, and who always ends up paying for it. The last time a Senate fiscal standoff reached this level of intensity, silver dropped 39% in a matter of weeks. Not months. Weeks. From nearly $50 an ounce down into the low 30s. Traders who thought they were safe because they owned hard assets watched their positions bleed out while the dollar surged and institutions rushed into cash and short-term treasuries. It was brutal. It was fast. And almost nobody saw it coming. Almost. So today, we're going to do something the mainstream financial media isn't doing. We're going to slow this down. We're going to look at the actual mechanics, the institutional behavior, the macro pressure points, the historical precedent, and we're going to be honest about what this Senate moment could mean for silver. Not with sensationalism, not with conspiracy, with the kind of structured, serious analysis that lets you walk away actually knowing something. Because silver right now is not a simple story. It never is. Silver lives at the intersection of industrial demand, monetary policy, safe haven psychology, and speculative positioning, and every one of those factors is currently being pulled in a different direction. The result is a market that is simultaneously one of the most compelling opportunities and one of the most dangerous trades on the board. Let's start with where silver is right now. In 2025, silver has been on a remarkable run. After years of suppression and underperformance relative to gold, silver finally started to close the gap. The gold-to-silver ratio, which hit extreme levels above 90 during peak uncertainty periods, has been compressing. Industrial demand, driven by solar panel manufacturing, electric vehicle components, and advanced electronics, has been absorbing physical supply at a rate that the market hasn't fully internalized yet. The Silver Institute's data has consistently shown structural supply deficits, meaning the world is consuming more silver than it's mining for the third and fourth consecutive year running. So fundamentally, the long-term case for silver remains intact. That matters. We need to hold on to that truth even as we walk through what could happen in the short term, because the short term is where the danger lives. Here's what the Senate is dealing with right now. The United States is once again brushing against its debt ceiling. Congress has been in a protracted negotiation over a fiscal package that includes spending cuts, debt ceiling suspension, and a range of provisions that different factions are using as leverage. The exact shape of any deal, or the failure to reach one, carries enormous implications for the dollar, for treasury markets, and by extension for the entire commodity complex. Now, you might wonder, why would a Senate vote crash silver? Silver is a physical commodity. It has real industrial uses. It's not a paper asset. Why would Washington politics move the price of something dug out of the ground in Mexico and Peru? The answer lies in understanding what silver actually is. And what it is two things at once. Silver is an industrial metal, yes, but silver is also a monetary metal. It has been used as money for longer than recorded history can trace. And in moments of institutional stress, silver doesn't behave like copper or zinc. It behaves like a leveraged version of gold, amplified, reactive, and deeply sensitive to the same macro forces that move currencies and sovereign debt. When Washington enters a genuine fiscal crisis, not a theatrical one, but a real one where the market starts to question the path of U.S. debt sustainability, the initial move is almost never into silver. The initial move is into the dollar and short-duration treasuries. Institutional investors, hedge funds, and sovereign wealth managers who are long-risk assets, including commodities, sell first and ask questions later. We saw this in 2011. We saw it in 2013. We saw it in 2020. And each time, silver took the hardest hit in the commodity space. Not because the long-term case collapsed, but because silver, with its smaller market size and higher speculative positioning, becomes a source of liquidity when everything else is moving against you. The 39% drop I mentioned, that was 2011. And to understand why it's relevant to today, you need to understand what was actually happening in 2011. In the spring of 2011, silver ran from around $18 an ounce all the way to just under $50. It was one of the most explosive commodity rallies in modern history. The drivers were real. Post-2008 monetary expansion, dollar weakness, genuine inflation concern, and industrial demand recovery. Sound familiar? The macro backdrop in 2025 rhymes with 2011 in ways that should make serious investors sit up straight. But then came the combination that broke silver's back. The CME, the Chicago Mercantile Exchange, raised margin requirements on silver futures 5 times in less than 2 weeks. This forced leveraged traders to either deposit more capital or liquidate their positions. The liquidation cascade was violent and self-reinforcing, and it happened against the backdrop of a broader fiscal and political uncertainty in Washington over the debt ceiling that was dominating headlines at the same time. The political noise fed the volatility triggered the margin calls. The margin calls triggered forced selling. The forced selling pushed prices down, which triggered more margin calls. Silver fell from $49 to below $33 in less than 2 months. By the time the recovery came, most retail traders had been shaken out at the bottom. That is the mechanism. That is what you need to understand. It's not that the fundamentals changed overnight. It's that the market structure, the leverage, the positioning, the institutional behavior became the enemy of everyone who was long at the top. Now let's bring this back to May 2025. Here's what we know. Congressional negotiations over the debt ceiling and fiscal package have been contentious. There are competing factions pulling in different directions. The House and Senate have not been aligned. The timeline is compressed, and the markets are watching. Here's what we also know. Silver's speculative positioning, measured through the Commitments of Traders report published weekly by the CFTC, has been elevated. Managed money, which is the category that includes hedge funds and systematic traders, has been net long silver to a degree that reflects genuine bullish conviction. That's not inherently dangerous, but it does mean that if sentiment shifts, there's a lot of paper that needs to unwind. The physical market remains tight, but the paper market, the futures market, the ETF flows, is where price is set in the short term. And paper markets respond to narrative, to sentiment, to macro headlines. And right now, the macro headline that could move everything is coming from the United States Senate. If a deal is reached that the market interprets as credible and fiscally responsible, meaning it actually addresses the trajectory of U.S. debt in a meaningful way, the dollar could strengthen, treasury yields could normalize, and risk assets could rally. In that scenario, silver might pull back modestly from elevated levels, but would likely find support on the industrial demand story. If a deal is reached that the market sees as a short-term patch, more debt ceiling suspension without structural reform, more spending without corresponding adjustment, the initial reaction could still be a dollar rally on crisis-avoided sentiment, followed by a longer-term erosion of dollar confidence that would ultimately benefit silver. This is the most nuanced scenario, the short-term pain, the medium-term gain. But if negotiations break down, if we get a genuine impasse, a scenario where Treasury starts using extraordinary measures and the market starts seriously pricing in a technical default or credit downgrade, that is where silver gets dangerous. Because in that scenario, institutional de-risking happens fast. The dollar counterintuitively strengthens as a flight to safety play. Commodity positions, especially heavily leveraged ones, get unwound. And silver, which is the most volatile and most leveraged of the major precious metals markets, falls the hardest and fastest. This is not a fringe scenario. This is exactly what rating agencies and market strategists have been modeling. And it is exactly the kind of macro event that catches retail silver holders off guard because they assume that political chaos means dollar weakness, which should mean silver strength. And they are right, eventually. But eventually can cost you 39%. So let's talk about what serious investors actually do in this environment. The first thing is to understand your own position structure. If you own physical silver, coins, bars, allocated metal, you are insulated from the paper market cascade in a way that leveraged traders are not. Physical silver holders can ride through a 30% drawdown if they don't panic, and if their time horizon is genuinely long-term. The metal isn't going anywhere. The fundamental demand story doesn't change because of a Senate vote. But you have to be psychologically prepared for the drawdown to be real and sustained for a period. If you own silver through ETFs, SLV, SIVR, or similar vehicles, you're in a more complex position. ETF prices track spot silver closely, so you get full exposure to the downside. But unlike a futures trader, you're not facing margin calls. You can hold through the volatility. The risk is behavioral, the temptation to sell at the bottom when the news cycle is at its most frightening. If you're trading silver futures or options, the calculus changes entirely. This is where the 2011 scenario is most directly applicable. If the Senate vote triggers a volatility spike, futures traders face exactly the kind of forced liquidation risk that created the 2011 cascade. Position sizing, stop placement, and cash reserves matter enormously in this environment. Now, let's zoom out to the macro level, because the Senate vote doesn't exist in isolation. The Federal Reserve is navigating one of the most complex policy environments in decades. Inflation has been stubborn. The labor market, while cooling, has not cracked. The Fed has signaled that it is not in a rush to cut rates. And every time rate cut expectations get pushed out, real yields stay elevated, which creates headwinds for non-yielding assets like silver and gold. At the same time, global central bank gold buying has been at record or near record levels for 3 consecutive years. China, India, Poland, Turkey, Central banks that were once content to hold treasuries as reserves are diversifying. This isn't a rumor, it's documented in IMF data. And while these institutions primarily buy gold, the monetary re-rating of gold that central bank demand is driving has historically pulled silver along as sentiment shifts toward hard money assets. The tension, then, is between short-term institutional behavior, which under fiscal stress tends to favor cash and treasuries, and long-term structural behavior, which is moving global reserve management away from dollar-denominated paper and toward physical metal. Silver sits in the middle of this tension, and the Senate vote is, in a very real sense, a test of which force wins the near-term narrative battle. There's another dimension to this that almost nobody is discussing right now. The green energy transition has created a structural demand floor under silver that simply did not exist in 2011. Solar photovoltaic cells require silver paste as a conductor. Each solar panel uses approximately 20 milligrams of silver per watt of capacity. Global solar installation targets, driven by policy in the United States, Europe, China, and India, are measured in hundreds of gigawatts per year. The arithmetic is sobering. We are talking about silver demand from solar alone that represents a meaningful percentage of global annual mine supply, and that demand is forecast to grow significantly over the rest of this decade. This is one reason why silver's supply deficit has persisted even as prices have risen. Higher prices normally incentivize more mining, but silver mining faces its own structural challenges. Most silver is produced as a byproduct of copper, zinc, and lead mining, which means silver supply is partially determined by base metal economics, not silver economics. You can't simply turn on more silver mines because the silver price goes up if the lead mines aren't economically viable. What this means for the current moment is that any price correction driven by the Senate vote and related macro uncertainty would be hitting silver at a time when the physical market is genuinely tight. That doesn't prevent the paper price from falling. We've seen repeatedly that paper price and physical reality can diverge significantly over short periods, but it does suggest that any correction driven by political rather than fundamental factors would create buying opportunities of a kind that the market hasn't seen in years. The question is whether you have the conviction, the patience, and the financial resilience to be a buyer into that correction rather than a seller out of panic. History is instructive here. The investors who bought silver in May 2011 after the 39% crash, those who understood that the fundamental case hadn't changed, that the monetary expansion that drove the initial rally was not reversing, that the industrial demand story was real. Those investors were eventually rewarded. It took time. It required sitting through continued volatility. But the metal was not broken. It was repriced by mechanics, not by a change in the underlying reality. We may be approaching a similar inflection point. Let's be honest about the uncertainties, because intellectual honesty matters more than being compelling. We do not know the exact outcome of the Senate vote. We do not know whether any deal reached will be seen as credible by markets. We do not know whether a correction, if it comes, will be 10% or 39% or something in between. We do not know precisely how leveraged the current speculative position in silver is, though the CFTC data gives us useful signals. What we do know is the structure of the risk. What we do know is the historical precedent. What we do know is that Washington's fiscal decisions have consistently moved silver in ways that weren't intuitive to investors, who only thought about silver in terms of its physical fundamentals. The smart investor right now isn't making binary bets. The smart investor is stress testing their position against a 25-30% downside scenario, asking whether they can hold, whether they need to hold, and what their actual time horizon looks like. The smart investor is watching the dollar index, watching the 10-year treasury yield, and watching the VIX as leading indicators of whether institutional de-risking is actually beginning. The smart investor is separating the short-term political noise from the long-term structural signal. Because here's the final truth about silver, and about moments like this one. Silver is one of the few assets that occupies multiple roles simultaneously: industrial input, monetary metal, speculative vehicle. That complexity is precisely why it can move violently in both directions, over short periods, while maintaining a long-term trajectory rooted in genuine supply-demand fundamentals. The Senate vote cannot change how much silver is in the ground. It cannot change how many solar panels the world needs to build. It cannot change the fact that central banks are quietly reassessing their relationship with dollar-denominated reserves. It cannot change the deficit math of the physical market. What it can change is sentiment, and in the short term, sentiment is everything. We are living in a moment where macro volatility is structural, not episodic, where every Washington decision carries global implications, where the institutions that set short-term price are playing a different game, with different time horizons and different incentive structures, than the individual investor who is trying to protect and grow wealth over years and decades. Understanding that gap between institutional short-termism and long-term fundamental reality is not just intellectually satisfying. It is the actual edge. It is the thing that lets you watch a 39% drop without losing your mind, because you understand what caused it, what it didn't change, and what comes after. May 11th is a date worth watching. The Senate vote is a catalyst worth understanding. The history is real, and it rhymes. But silver's story is longer than any vote, and the investors who know that are the ones who end up on the right side of history.